Okay, it's Friday the 14th, and I know what you guys want to hear about: gold, of course. Once gold broke that 1800 to 1820 really strong resistance level, I knew that 1934, the old high, wouldn't be much resistance. So gold, did run up there. 2089 was as high as I saw it, so about a 7% higher high than previous. And gold did look like it needed to take a correction, and silver went just crazy, from $11.64 up to almost 30 in just, since March. A catch-up rally. It just shows how desperate the markets are. Money's got to go somewhere, so when gold runs too far, well, then silver plays catch-up. And when the NASDAQ runs too far, then the Russell 2000 plays catch-up and stuff like that. So it's kind of the markets are very maniacal right now. But what I always like to do is just, get perspective. If I was thinking like a trader right here, I would rather be short stocks than long gold, because I don't see a lot of upside potential in gold. And I'll show why. Andy Pancholi at the Market Timing Report did a whole issue in August on gold, and he had a lot of charts, but one I liked the most went through the highs back to 1980 and 2011, and that would be suggesting later this year, which is, I see gold rallying into the early stages of the next crash like it did in 2008, okay? So I think it could be later this year, early next year. In that time frame, the projection would be about 2,200 or just above that. Another interesting perspective, I just saw somebody did gold, which is a good measure, adjusted for inflation, because gold most correlates with inflation long term. But of course, when inflation's really strong, like in the 70s, or when money printing is so strong here, it's going to have an exaggerated view of it. So if you adjust gold into 2020 present dollars and go back and look at the highs in 1980 and 2011, both those in inflation adjusted dollars would suggest a target of gold for about 2230. So very close. Andy Pancholi's trend line hit about 2200. He had a number of charts. He had one that pointed at 2400, and that's possible, but I thought the one made the most sense. So 2200 is not a lot higher than we just went. And gold does look like, unlike silver, which had a full like five wave rally here, really crazy rally, gold looks like it has another wave up, whereas silver may not make a new high. So I could see gold going to 2200 easily. It might go higher, but that's not that much potential. But even better perspective, how do I compare gold? Where should gold be if it weren't in such a bubble? And gold is trading bubbly and has been, since 2008 when it took off with all this money printing and stuff. Gold, compared to the CRB index, the commodity index, which it correlates with long-term 30-year cycle, gold is 65% more overvalued compared to the CRB index. It is, even after this incredibly crazy rally in silver from 12 to 29, 30, it's 45% overvalued relative to silver, and it's 58% overvalued relative to its other precious metal, brother, sister, platinum. So that gives you an idea. And gold's lows recently, about $1,450, okay? So that's not a terrible downside. Silver, 1164, silver could fall 60% or more. And my target, still for gold, is about the same, around 1,050 at its late 2015 low, or maybe just below that, 950 to 1,000. So, but with these new highs, I would put that target more. The 1,050 target would make more sense. That's 50% downside. That is not terrible in the greatest bubble in history, where silver could go down 70, 80%, stocks could go down 85, 90%, and that sort of thing. So that's gold is very overvalued. Don't think gold's a bargain here. Everything's overvalued here. Everything's in a bubble. All risk assets are bubbling up. But stocks are the worst. I do have a good measure for what stocks should be, and it's called the spending wave. I think you've probably heard about that. The spending wave at the top in February was about 100, stocks were 120% overvalued versus where the spending wave said they should be really towards the lower end of the baby boom downturn. So that's really overvalued. So, gold's, let's say 50% overvalued. When you look at all those indicators, I just like, well, stocks are more than double that, 120% overvalued. So stocks are the worst. They're the worst of the bubble. I've shown in a lot of recent issues of the HS Dent forecast how, overvalued stocks are and ahead of themselves here, and how they've gotten the biggest bang. Yes, bonds have been pushed up. Of course, they buy bonds and push down rates. And real estate has had great gains as in a bubble, but stocks have had the strongest bubble. And you would expect that because they benefit from everything, from lower rates, from higher money having to come in and find a place to park. And of course, an economy on crack, doing way better than it should. How could you have the greatest bubble in stocks in history when the economy, the recovery was 2% real gains, and that took $25 trillion in cumulative stimulus, not to count the fiscal stimulus. So again, stocks are the worst here. So just perspective. But again, don't think, and I know Peter Schiff and all the gold bugs down here in Puerto Rico, they want me to convert over and say, oh yeah, okay, gold's probably going to 3,000 or 4,000. I do not see that. Gold is still an inflation hedge. Deflation, which is what I see coming. I see no way around us having some level, if not a high level of deflation when this bubble finally unwinds and debts finally unwind and the central banks lose control, which they're losing control very quickly. They had to print more money in 8 months than they did in the whole QE cycle for 6 or 7 years. That shows how much control they're losing. They can't keep doing that. So stocks have the most downside potential. Gold, if it just falls 50%, will be the best of the commodity complex, okay? It's still a 50% loss. So I see gold could go higher, 2,200, maybe a little higher than that. Not bad, but is that worth getting in? Hey, if you got gold, I would hold on to it and consider selling there or higher if it goes. But I wouldn't be jumping into gold here because I don't see the potential. Now, a lot of people may, and I know the gold bugs are jumping up and down here, but I just wanted to add some perspective on this Friday rant. And in the next week, I've been waiting for gold to kind of have this pullback. It looked like it needed to have, and see where it settles out and see, it does look like it's got at least one more good run to go, from maybe, 2,000 or so up to 2,200, or so. So I'll have an update for subscribers, when I think I've got a clear picture on what that run could look like and when. But for now, gold just looks good. But it's a rare thing, number one, for gold to break to new highs after peaking in the 30-year cycle. It never did that before. This is rare, and it is precisely because governments are printing so much money that the assumption is you got to get some inflation here somewhere. I'm just telling you, the gold bug's going to be disappointed. We might get 3% inflation or something. You're not going to see 10 or 20% inflation, nevertheless, runaway hyperinflation. It cannot happen in this environment. And we've already printed $25 trillion, and there's a lot more coming, and still don't have any serious inflation anywhere in the world for developed countries. So that's the reality. We're in a deflationary environment. Only money printing is countering this. The money printing is to fight deflation, not to create hyperinflation. That is not the fundamental trend. If it was, gold would be the best place to be. So we'll keep you updated. Gold looks good, but doesn't look that great.